Should you go for rental yield or capital appreciation? Let me know your answers in the comments first. When it comes to making money from your property, there are always two camps: rental yield and capital appreciation. In a perfect world, of course, we will want to have both. But in reality, you can only choose one. So the question here is this: which will you choose? Let's dive into some numbers, so let me put on my smart glasses. As you know already, I'm a numbers guy, so let's take a look at both scenarios to see which is better. Let's take a look at rental yield first, specifically the magical word being splashed around by gurus nowadays: cash flow positive. Let's put it to the test by crunching some numbers. Usually in Singapore, only commercial or industrial properties are able to give you a positive cash flow. Let's take this industrial property in Woodlands Horizon for example. It's 1,722 square feet at a price of $668,000. Based on this purchase price, your mortgage works out to $534,400, which means your monthly installment is going to be $2,111 per month. And let's say you manage to rent it out at $3,000 per month, representing a 5.3% gross rental yield. Not bad. You will receive $889 per month in positive cash flow. Wow, after 5 years, I'm going to be rich. After 5 years of collecting positive cash flow, you have a grand total of $53,340. I know some of you might be thinking, but Ian, I also collect the principal of my mortgage. And that's true. However, all properties are a form of forced savings. So let's ignore that and keep to the main variables, which are rental yield and capital appreciation. So as you can see, positive cash flow or having a high rental yield isn't practical. If you think an extra $889 per month is going to make you financially free, well, good for you.
Wow.
Let's take a look at capital appreciation now and put it to the test. I'm going to pull out the historical data and show you the average capital appreciation over the years. And the segment that sees the highest growth is usually the residential segment due to the high and constant demand. Everybody needs a home. It's not a want. As we can see, residential properties have grown at a rate of 8% over the last 10 years. And for equal comparison's sake, let's just assume you buy a condominium for the same $668,000 as with our rental example. Assuming a 8% appreciation per year, your gross profit after 5 years is $313,511. Now this is a gross amount, so we need to minus off the interest and the other fees paid over the years, which gives us $230,528. This seems like a more realistic approach to achieve financial freedom in the shortest time possible. Let's compare the numbers again. Rental yield versus capital appreciation. Which will you choose? Let me know your answers in the comments below. Personally, I always aim for capital appreciation. Just think for yourselves, to make the same $230,000 profit with positive cash flow, you'll need to collect rental consecutively for 21 years just to match this same amount. Does that make sense to you? Now I want to add a caveat. Not all residential properties are a good buy. In fact, buying the wrong property could mean subpar profits or even severe losses. So if you want to find out how you can identify the right property that can make six-figure profits, I'm having an upcoming webinar where I'll be sharing with you the secrets to make consistent six-figure profits through your property. Link in the comments below. And as always, if you like such interesting real estate content, follow me, like, and share for more.